I think we're in a lot of trouble economically. I made a name for myself predicting the 2008 financial crisis, which was obvious to me based on my understanding of Austrian economics. And I understood the mistakes that the Fed was making and how the mistakes were going to result in a financial crisis. And the same understanding that led me to believe that crisis was coming leads me to believe an even bigger one is coming. And that's going to be a sovereign debt crisis, a US dollar crisis. And, who knows? I mean, it could be days away, it could be months away, maybe a few more years, hard to say. But I think we're dangerously close to a major collapse. There are other bears like, Harry Dent, who's bearish. And we're not necessarily always bearish for the same reasons, but we have some overlap. But he's always said, oh, well, so, be in U.S. Treasuries because I'm so bearish on everything. And but I'm also bearish on the dollar. I don't want to be in Treasuries. It's like, right. He's always saying, oh, gold's going to crash. It's going to go to 500. I go, well, I know. Why would it do that?
We are standing on the precipice of an economic shifting of gears, a moment where the structural faults of our financial architecture are beginning to fracture under the weight of historic deficits. The current trajectory suggests that traditional safe havens may no longer offer the sanctuary they once did, forcing a complete reassessment of global wealth preservation. Peter Schiff, a prominent global strategist and Austrian economist, argues that the global economy is accelerating toward a massive sovereign debt and currency crisis. He emphasizes that the mistakes made by central banks are paving the way for an inescapable collapse, predicting that the world will inevitably reject fiat currencies and return to gold as the foundational reserve asset. The structural imbalances we see today are vastly different from past cycles, meaning the upcoming correction will likely catch the broader market completely off guard. Tokenization might allow assets like gold to circulate digitally, offering a stable medium of exchange that protects purchasing power from rampant inflation. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I think we're in a lot of trouble economically. I made a name for myself predicting the 2008 financial crisis, which was obvious to me based on my understanding of Austrian economics. And I understood the mistakes that the Fed was making and how the mistakes were going to result in a financial crisis. And the same understanding that led me to believe that crisis was coming leads me to believe an even bigger one is coming. And that's going to be a sovereign debt crisis, a US dollar crisis. And, who knows? I mean, it could be days away, it could be months away, maybe a few more years, hard to say. But I think we're dangerously close to a major collapse. You're talking about central banks holding it and settling it. You're not talking about individuals using it to buy lunch. You're talking about central bank reserves. And so there, I think that, central banks, and they're already moving away. In fact, gold is now a larger percentage of central bank reserves than treasury. So they're already moving in that direction of replacing their dollars with gold. That's what's happening. It's not the euro that's going to take the place of the dollar or the yen. Certainly it's at a 40-year low today, but it's not going to be the pound. It's not going to be the RMB. The world's going back to gold as the reserve. Now, as far as a medium of exchange in everyday commerce, I think that could happen as well because of tokenization. A lot of people talk about stable coins and they say it's a lot easier to use Tether or USDT than dollars for certain transactions, certainly cross-border transactions. If you're trying to send money to Europe, a lot easier than trying to do a bank wire or something like that. Well, you can do the same thing with gold. You could tokenize gold. The gold could sit in a vault in Switzerland, and the tokens can exist on a blockchain. And then I can send you some gold instantaneously for nothing, and we can conduct commerce with one another. I can buy, I can sell, we can pay each other in gold. We don't have to physically hand the gold to one another, just like I don't have to physically hand you my dollars. I can send them to you electronically. Well, we can send gold ownership electronically. The gold itself doesn't go anywhere. It just sits in a vault, but it's in a vault and it belongs to me. But when I send you the token, now it belongs to you. Either one of us can go and get it whenever we want. We can redeem the token for the physical, but why would we? Just let it sit there. What are we going to do with it? Just leave it in a vault, and we can use the token that represents the ownership to settle our transactions. And the reason that that's so much better than using dollars is because between the time I earn my gold and the time I decide to spend it, it's not going to be losing value. Whereas the dollar is going to lose a lot of value. Now, if I spend my dollars instantly, if I earn them and then I go immediately spend them, it doesn't lose that much. But if I earn some dollars, set them aside for a few years, and then try to spend them, I'm not going to get nearly as much. But if I earn gold and save that, and then when I go to spend gold, it'll probably buy me more, not buy me less. There are other bears like, Harry Dent, who's bearish. And we're not necessarily always bearish for the same reasons, but we have some overlap. But he's always said, oh, well, so, be in U.S. Treasuries because I'm so bearish on everything. And but I'm also bearish on the dollar. I don't want to be in Treasuries. It's like,
right.
He's always, oh, gold's going to crash. It's going to go to 500. I go, well, I know. Why would it do that? So, and he's always thinking the Dow is going to crash. Look, I think the Dow is overpriced. The S&P is overpriced. In fact, it's the most overpriced it's ever been.
Yeah.
But I think a lot of that is a function of the inflationary environment that we've been operating in.
Right.
And the stock market is discounting future inflation. That's going to be rampant.
Right.
But, I would rather buy other stocks and get a better deal, a lower valuation. In fact, I was even watching an interview with Jeff Gundlach the other day, who's not a stock manager. He's a bond manager. But he was saying that he thinks that American citizens, not foreigners, Americans who invest in the stock market, and he thought they should have about 40% of their portfolios in stocks right now, which is less than a lot of people would say, but 40%. But he said 100% of that 40% should be foreign. No U.S. exposure. That's how expensive our market is. But that doesn't mean you don't invest in stocks. You just find stocks that are a better deal, right? You don't just say, well, the stock market's expensive. Let me leave my money in cash. That could be even worse. The cash could lose more value than overpriced stocks. I want to find underpriced stocks, and they're there. They're just not here.
The financial system has managed to sustain massive debt loads primarily by generating nominal inflation, a dynamic that artificially elevates the stock market while quietly eroding the purchasing power of anyone holding cash. This ongoing dilution of currency means that traditional metrics of market growth are largely an illusion driven by a weakening dollar. Right now, the interest on the national debt is spiraling completely out of control, annualized at over $1.6 trillion and rapidly heading toward the $2 trillion mark next year. This imminent threshold will swallow roughly 40% of all tax revenues just to service existing debt, making a major sovereign collapse a mathematical certainty rather than a mere possibility. With the S&P and the Dow structurally overpriced due to this inflationary environment, the domestic market is looking increasingly dangerous for long-term capital. True security won't be found in overvalued domestic equities or depreciating paper cash, but rather in deeply undervalued foreign assets and hard commodities that sit entirely outside the inflationary loop. Now, let's get back to the interview.
The debt was not a reason not to own the stock market, because the way that we've been able to handle the debt is by creating inflation. And inflation benefits the stock market. So, people have benefited from those dynamics by being invested in stocks. The people who have been harmed by inflation were people that just held cash. Because if you didn't do something, if you just left your money in cash, inflation. And inflation was created because of the debt, because we have to keep reducing the size of the debt by making the numbers bigger, by making the economy bigger through inflation. It's nominal, not real. But the dynamics are there. I mean, we caught a lot of breaks over the years. I mean, women coming into the workforce helped us a lot because now we had an extra worker to help pay the debts. Outsourcing our manufacturing to China really helped because now we had a source of low-cost goods that we didn't have to produce. And the dollar's reserve status really helped because, even though we had a lot of debt, people didn't care. They just kept lending us money anyway. And so we were able to take on a lot more debt than people might have imagined back then. But at this point, it's spiraling out of control. I mean, obviously, there is a limit. Just because we've taken on a lot more debt than people would have thought back then doesn't mean there's no limit. I mean, right now, it's almost $40 trillion national debt. But looking at just the debt service, if you take May's number, the May numbers, and annualize it, we're spending $1.6 trillion a year on interest. Now, that's more than the entire budget as late as 1997. We're spending that much in interest. So, and it's not going to stop. Sometime next year, we're going to hit $2 trillion in interest. That's going to be like 40% of our tax revenue, just interest on the debt. And again, that's not the ceiling. It's going to keep rising until we do something about it, which we won't until we have a crisis. That's why Hank Paulson a couple months ago said we need an emergency plan for a debt crisis. And he didn't say that we need to have an emergency meeting right now to avoid the debt crisis. Let's take preemptive action now. No. He just said, look, the crisis is inevitable. There's nothing we're going to do to stop it. So what's our plan to deal with it when it happens, right? That's what he's saying. When you look at these central bankers in the U.S., and they will admit that we're on an unsustainable path, right? They'll say, look, the debt itself isn't unsustainable, but the path is, meaning that they recognize that if we stay on this path, the debt that is now sustainable won't be. And what I've always said is it's not the path, it is the debt, because the debt is on this path. It's not going off of it. So you can't say it's sustainable now. It's like, I jump off the top of the Empire State Building and I say, well, yeah, everything is sustainable until I hit the pavement. It doesn't matter. Once I jumped, hitting the pavement is inevitable. It's not like something that may happen. It's a foregone conclusion. So we are on this unsustainable track, and we are going to get to the unsustainable destination because there's no derailing us from this track. There's no attempt to do it, and nobody wants to do it. And then if you admit, okay, we're on an unsustainable path, but you don't know where the unsustainable destination is. So how do you know when you're about to hit it, right? If you concede that eventually it's unsustainable, how do you know when that is? Because you only know when it is when it's not.
Right.
And that's because you had a crisis.
Right.
So then it's too late. It's like, when should I stop smoking? Well, I'm going to wait till I get cancer. All right. But what good does it do you now to stop smoking once you got cancer, right? It's like,
A look at modern central banking reserves reveals that a quiet migration is already underway, as global institutions steadily swap out their U.S. Treasury holdings in favor of physical gold. This internal shift signals a systemic loss of confidence in the dollar's long-term viability as the world's premier reserve standard. The upcoming economic reckoning is expected to trigger a major collapse that will redefine global commerce, forcing a decentralized return to tangible, asset-backed wealth. Hoping that policymakers will self-correct before hitting the pavement is a dangerous gamble, as history proves interventions are only staged after a crisis has fully arrived. True financial resilience requires moving away from liabilities and positioning capital where it cannot be inflated away by central bank printing presses. Protecting your wealth means recognizing these structural shifts early and adjusting your portfolio before the broader market panics. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.